Oh, so silly. All right, so bad. 700 points down. Let's see, coming into the 2.5% rule. If we don't bounce here, we're in big trouble. Yep. All right, hey, it might be a good time to look at those rules and see how that stuff works. Okay. The Russell's down much more than 2.5% already. So we got problems, people. We have issues. What should we talk about? Oh. So somebody in chat asked me, where's the bottom on Bank of America, I think it was, or whatever. Anyway, you can't. This is a trap that we all fell into in 2008 because let's go to the, look, you guys know there's nothing I like more than buying things on sale. This is what I live for. This is what I wait for. This is why I go to cash in November and wait for a market drop, okay? But this is not necessarily the whole market drop. Is this Phil? Okay, yes. Okay. You've got to understand that you can't just decide it's a bottom. This is how people really lost money in 2008 because they were too quick to call a bottom. Oh, I love that picture. Very cool. Oh, that's weird. Do they all do that? Sort of turns color when you mouse over it. No, they don't all do that. That's kind of interesting. I wish I understood more about web stuff. Maybe one day, maybe my chatbot can teach me. I haven't been able to learn so far all these years. I never really, my brain doesn't work that way, web design and stuff. And it's all detail oriented with little fiddly bits. It's like medical school, it's like there's too many parts. I would have been a great doctor. I'd be great at diagnosing, but I would be totally useless at like actually doing anything about it because then you got to remember all your little details. All right, so where are we? What was I talking about? 2008. There we go. That's kind of small. That's better. So look, here's what happened. In 2007, this is the beginning of 2008, really, the end of 2007, we started selling off. And because there were issues around the world, the Fed didn't just say, roll out of bed and say, oh, let's have liquidity tests and so on and so forth. There were banks in Europe that were going under and banks in Asia that were going under. Little, small banks, no big deal, but little banks. And it was making people nervous. And the Fed decided to check the liquidity of our banks. But that then revealed that certain banks had serious issues like Bear Stearns. So Bear Stearns very well, at what we called at the time quickly, by March, Bear Stearns was dead. In 3 months, looking under the hood and seeing what was going on destroyed Bear Stearns because they were way too exposed. They didn't have enough coverage. They had liquidity issues, blah, 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 blah. Basically exactly what just happened in Silicon Valley Bank. So the Fed steps in and does whatever they did with Bear Stearns, and it was, quote, fixed. This is 3 months though, and then it took about weeks of crisis, and then we started going back up, and we recovered a lot. What's this number? This is 15, right? So we go from 15 to 13 is 2,000 is what, like about 15% down, right? So we drop about 15%, Then we go from 13 to 14. That's only 1 out of 13. That's like 8%. So we come 8% back up after dropping 15, basically a 50% recovery, right? But then everything goes off the cliff again. So a lot of people jump in here, and here, and again, you guys are here. This is here. This is 2 days after we think there's a problem, and everybody wants to jump back in, and they will. And that's what happens here. People jump back in, they go, yay, look what I found. And then all of a sudden, big collapse. So everything seemed great or getting better, and people are bargain shopping, and everybody's fear of missing out, and everybody's buying stuff, and blah, blah, blah. And then we go boo-doo-doo all the way back down again. But we're only back down to kind of the lows. So people are buying more and saying, yeah, what a great chance to buy more stuff. I missed the low before, but now we're right at the low. Let's buy more stuff. Okay. This is when IndyMac went down. This is when they enacted the Economic Recovery Act and so on and so forth. So everything, government support, everything's here. The Fed's backing it up, blah, blah, blah. So another bounce, but now it's what? Now it's a weak bounce, right? We know the difference between a weak bounce and a strong bounce. So all that, and you get a weak bounce, and that's where I'm raising the warnings and saying that's only a weak bounce, guys. That's nothing to invest in. Then Freddie and Fannie went under because it was mortgage driven. Don't forget, at the time, the housing was collapsing, and that meant everybody had to write down all their housing assets, which obviously is ridiculous. You know, if you tell these banks they have to mark down their housing assets, they're all broke. And then AIG, who insured all AIG, who were insuring all these credit swaps, they went under because there was complete bullshit. They no way, shape, or form had the actual money to insure them. You know, these insurance companies, that goes for your life insurance and home insurance too. If there's a nuclear bomb and New York City is wiped off the map, then Prudential's not going to pay everybody. Not there'll be anyone left to pay, but Prudential's not going to pay everybody. They'll be bankrupt. They insured $1 trillion worth of property that got wiped out in one shot. They don't have $1 trillion. They have hundreds of billions of dollars, and the assumption is there's no possible way that all this stuff is going to go bad at once, but it could happen. You know, that's banks, insurance companies, anything. I mean, all finance is based on a percentage of risk. If the insurance companies, if you go, think about it, because if you get a life insurance policy, right, you give them, I don't know, what is it, like, let's say you have $1 million policy and you're paying $600 a month for your $1 million policy, $6,000 a year, right? That's your life insurance. The concept is that the bank or the insurance company is investing $6,000 a year, just like you should invest $6,000 a year, just like our $700 a month portfolio, right? That's what it's based on. They're going to take the money and make conservative investments that will pay them a steady rate of return that will make them all the money they have to pay you. But since they collect over time, if it's $6,000 a year, which is like our $700 a month portfolio, right? If it's, say, $6,000 a year, and I give it to them for 30 years, they're going to make $1 million, and they'll have more than $1 million. And anything more than $1 million is profit, because my policy is still $1 million policy. And if I live more than 30 years, they will accumulate more and more money that they won't have to pay me. And they will also keep collecting $6,000 a year for me, which they won't have to, which they won't additionally pay me. They're only still going to pay me the $1 million I signed up for on my life insurance. And that's based on actuarial tables. So when I'm 30 years old and I take out this policy, they say it's very unlikely I'm going to die before I'm 60 years old. And once I'm 60 years old, they will have their $1 million from what I gave them. That's what insurance, that's how it works. And the insurance company then takes that money and invests it. Now, if they take it from one person, they're taking on a huge risk. But if they take it from millions of people, then statistics take over, and the average person lives until 72 years old. Therefore, they're going to get 42 years worth of payments out of me. They run the same numbers we run for the $700 a month portfolio, and they say, okay, we're going to be totally covered on this $1 million. And that's all it is. That's their whole business. Is key is the additional profit they make off those investments. That's why we were liking insurance companies again as rates went up, because most of the insurance companies invest in very, very safe things like bonds. They just want to make sure they make 3, 4, 5% a year, and they're very happy on their reserves. They have tremendous reserves. And why 3, 4, 5 when you think they want to make 10? Because they've been doing this for 50 years already, or 100 years, and they've already got all the money and all the profits sitting in the bank from prior times. So yours is just gravy. They've already got enough. They've already got much, much more than enough money to pay out people. But the point is, if you look at it from a single insurance person from day one, if I am 30 years old and I start giving them $600 a month, and 6 months later I get hit by a bus, they didn't have $1 million to pay me. They only got $600 from me for 6 months. They got $3,600, and now they got to pay out $1 million. That's a big loser. And it's just like our Be the House model, right? You need to have a lot of games in play so that over time it will even out. You'll lose on certain individual bets, you're going to lose. But if you statistically do it, if you place enough bets that statistics become dominant, that statistics ever become dominant rather than random chance, then you will almost mathematically for certain make money. That's what insurance companies do. That's the whole concept of these things. Anyway, so the point being, though, that they don't have this kind of money. AIG, and again, same thing with Silicon Valley Bank, right? They suddenly grew. Silicon Valley Bank during the COVID grew 4 times in deposits. They did not have 4 times the money to pay back, because what they do is they take in money, they lend it out. They take in money, they lend it out, and they lend out much more than they take in. There's a multiplier effect to what they take in. The deposits grew because people were putting in COVID checks, and there were companies like, there were biotech companies that were exploding and getting capital. People were raising money. There were billion-dollar unicorns, blah, blah, blah. So all this money comes into, in a unicorn, a unicorn is a company that hits $1 billion in value. So a unicorn company raises $300 million in their first round of financing, and they put it all in the bank. They put it in Silicon Valley Bank because that was their bank when they were a tiny little company. And when they get their big check, they still stay with the Silicon Valley Bank. Silicon Valley Bank was a great bank. I used to love those guys. When they started out in the, I think they started out in the 80s, they were a small little bank that was just basically being great. They were super flexible with startups. They understood the problem startups had. They understood the money needs startups had. They were much nicer than almost any other bank about dealing with the funding issues and helping them out. It was a pleasure to work with them. They were fantastic for startups. They still are. That's always been their culture. But the problem is the startups grew to these massive sizes, and now the bank is taking on huge amounts of money. So they take the money in, and they only have to hold in reserve 10% of the money. That's the reserve requirement for the banks. So your startup gives them $300 million, right? They start a company, they got a little bit of money, they got 10 million, 20 million, whatever. Then all of a sudden they go to the next round, they raise $300 million. They put $300 million in Silicon Valley Bank. And don't forget, this happening over and over and over again. So their total deposits go from $50 billion to $200 billion in a couple of years. So the bank takes in $1 billion, and they keep only $100 million to service it, and they lend out $900 million is now loaned out to other companies, right? Now, the assumption of any normal bank is that the person is not going to come back and withdraw their $1 billion. But that's not really how that's not how it works. And now, because of the COVID crisis, there was bailout money. The bailout money dried up, and in reality, as I kept saying, business was not that good. And I kept pointing this out over and over and over again. I said, look at 2018. Don't look at last year. Don't look at the year before. You got to look at the pre-crisis years and the revenues and the earnings and compare it to this year, and you'll see that basically most companies are not even in better shape than they were in 2018. yet we're valuing them double what they were in 2018. That makes no sense. Why are we doing that? Of course, they're better than last year. Last year sucked, and the year before that sucked even worse. But that doesn't mean anything. What have they actually grown in the past 5 years to justify these valuations? And the answer is absolutely not. So therefore, you know, when they're not making the money you think they make, they have a pretty high burn rate, and now the government has stopped throwing money at them, and it became harder for them to raise additional money. So what do? They go back to Silicon Valley Bank and they say, hey, we need that, we need half of that, we need $400 million out of that billion we gave you. And Silicon Valley Bank's like, uh-oh, because they lent it out to people. They're making money on that money. They don't have it. So what happens is so because everybody in the valley, all companies, all tech companies were so crazy overvalued that they all had to start drawing down the cash reserves that they had in the bank. And they're all going back to Silicon Valley Bank at the same time and saying, we need our money, we need our money, we need our money. That's a run on the bank. It's not a panic run, it's a situational run because they're starting to burn the money and they're not making enough. And also they then become pressured, even if it's in good times, even if there's a good reason, even if it's because they want to buy somebody else because somebody else is having trouble, and they go back to Silicon Valley Bank and say, hey, I need that $1 billion I put in the bank because I'm going to buy these guys. Doesn't matter why you're taking your money out, it matters that you're taking your money out. Silicon Valley Bank did not have the reserves. And where were the bulk of the reserves they did have? Where were their cash reserves? Their cash reserves, a large portion of them were in treasuries. So not only did they not have enough money because they lent it out, but the money they did have was in T-bills that were paying them 0.5%. And now interest rates are 5%. So if you take a 0.5% T-bill and you cash it out, it's worth less than a 5% T-bill, worth 4.5% less for 2 years if it's a 2-year note. So it's worth 9% less. So they're actually they're taking a 9% loss because nobody now today is willing to buy a 0.5% T-bill at face value. Why would I? I can go to the government tomorrow and buy it for 5%. So why would I buy it from Silicon Valley Bank for face value? That makes no sense. So it is impossible to cash out the T-bills at face value. They were not marked down because Silicon Valley Bank had no intention of selling them. But when they were forced to sell them, they had to realize the 9% loss over 2 years on the interest rates. Now that then, let's say they had $20 billion worth of T-bills, that caused them, since they had to raise $20 billion in capital to get the money to meet the demand from the people who were withdrawing money, they then had to liquidate their T-bills for $20 billion. Liquidating their T-bills caused them to take a loss at that moment of $2 billion. Now they have to declare that they took a $2 billion loss, and now they have to announce that their first quarter income is going to be impacted by $2 billion. Then they have to turn around and say, well, we still don't have enough money. Would anybody like to give us some money? It's a bad time, right? It's a very, very bad time to ask. What they should have done is, instead of liquidating their T-bills, they should have first gone to JP Morgan, Goldman Sachs, Warren Buffett, and said, here's the deal. We're fucked. We need money. If you give us $50 billion, we'll give you the stock of the bank very quietly, and you'll be a major shareholder of the bank, and so on and so forth, blah, 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 and we'll avoid this crisis. If you don't, we're going to be in screwed. They didn't do that, though. They first liquidated and decided that they would, whatever the logic was, they first of all took the hit, and then they went to investors and said, would anybody like to invest? And everybody's like, no, you just lost $2 billion, you idiots. It's like, now you're screwed, because now everybody's freaking out. And also, unlike 15 years ago, 2008, everything is instant. We thought everything was instant back then because we had, you know, we didn't have. Did we have Twitter? I don't even know what we had. It's hard to remember. I will tell you, when we had the financial crisis in 2008. Okay, here's the thing. No, we didn't really have all this stuff, because I remember in 2008, on the day the market completely crashed out here on March, this date right here when the market completely collapsed, I was live on TV. I was supposed to be on a show for an hour in the city called Livestock, and I came in at noon, and we were supposed to do an hour show, but the market was collapsing. So I stayed for the whole thing. We did like a 4-hour show because we were just blow by blow dealing with the commentary. And I am just now at that point, I had already written an article saying how stupid this whole sell-off had been. And so at that point, I was just like, I'm sorry, but you got to buy. And I named like 23 different stocks and 23 different trade setups for people to buy. I was like, you got to buy this, you got to buy that. I said, look at Ford, look at Bank of America, look at Citibank, look at JP Morgan. I was like, there were so many things to buy that should not have been on sale the way they were. And there's a reason for that, though, because we were off 2/3. The S&P was from 1,500 to 600 at the time, or 666. In fact, I remember it was 666. It was funny. So it had fallen 2/3 basically. And I said, well, you know, you have to look at this in terms of like the global economy. Okay, so the global economy didn't fall 2/3. The average per person GDP in the world is something like $6,500. A person in Africa like a woman in Africa who puts a jug on her head and walks down to the river to get water and brings it back to the village and puts it in the village and picks some rice and makes dinner, he generates $2,500 worth of GDP in a year, which is not thrilling. It's $100 a day. Not $100. I'm sorry, $10 a day is generated by labor. It doesn't matter what you do. Just the fact that you exist effectively is going to generate $10 a day of GDP. I mean, I think we can all accept that, right? It doesn't matter how poor you are. If you breathe and you eat and you have clothing, you're going to be using $10 a day worth of GDP. So that's not even what we in the Western world would consider a survival economy, right? And I said, you know, nobody nuked us. We aren't incapable of doing anything. All that happens is we're having a financial collapse. Therefore, you know, you as a person, even if your bank was shut down tomorrow, even if you were homeless, the bank was shut down and all the businesses had collapsed, right? You're still going to wake up tomorrow morning and say, I am hungry. I want some breakfast. And you're going to figure out a way to get a job, and you're going to trade, and you're going to barter or whatever. It's not possible for the world to slip to this level. That was my point. It's a complete overreaction. Once you get below here, once you're down below 2/3 basically, it's not really realistic because it's a subsistence level. If you still have 8 billion people, you're going to be up around 1,000 on the S&P. And we were at 666, so we were 50% too low. So that's where I really put my foot down. I was like, just freaking buy whatever. It doesn't matter what you buy, just buy everything right now. So that's how we got there. What was I going to say? Okay. So that's what happened then. But keep in mind, though, that's after this massive, massive collapse. Look at this. Dow falls 778 points. How much are we down today? 550. So we were down 700 and something over here. So here's the total, the worst, one of the worst days of the financial collapse. Dow falls 778 points. Oh my God, so funny. Anyway, so the point being, though, that you can think you're recovering and you're not really recovering because things aren't actually better. And this takes ages, it takes months, it takes quarters to work out, not days. So we don't get overexcited about these mini recoveries. It's not worth getting excited about. We have to just put things into perspective. All right, so here's a STK Geek says, please provide your recommendations. Is it still a good time to enter the GLD trade? No, GOLD, the company gold. I wouldn't go for I wouldn't buy the physical gold. Minus 20% LB in a registered account. How can I play the downside? Well, I'm honestly at the moment, I can't take the short bet. We did in 2008. We took a lot of short bets and we did very well. That's my phone. Oh. So where are we? Yeah. So we took short bets, but again, I don't think we're going to have this kind of collapse. I'm not looking to make short bets. We have hedges. Those are our short bets. We do not have particular short bets. And as to gold, I would rather have the company Barrick Gold, GOLD, than bet the physical gold. First of all, physical gold's had a run already, whereas GOLD is, well, it came back a lot in the last few days, but GOLD is stupidly low. That's what I was saying that the other day, that I wanted to, if anything, you want to play that because it's just lagging so far behind gold. It makes no sense. And it's still a good price. I'll tell you what else is a good price. It's better than gold is SunPower, SPWR. Look at that, 13 bucks. 10% of the US solar is sold through SunPower. And they're at 13 bucks. That makes no sense. They're a good company. So that's a nice bargain. People are selling off everything like crazy. Anywho, all right. So, oh yeah. So I want to get to, where are PhilStockWorld? Watchlist Wednesday. Oh, good. That's where it is. Here's our watch list, which we made up in December. So let's see how our watch list is doing. Okay, so we have ACAM, very low, lower than they were in December. Allstate, totally, like I said, I like the insurance stocks. People are treating them like they're financials and they're selling them off. Good time to look at those guys. ADP employment, not sure I want to get that. Here's Apollo. Here's Broadcom, is still going strong. Boeing having a little bit of a sell-off, and Boeing is, coming around to the part where they finally become profitable. BCS, another bank in trouble. Big Lots never did well, never picked up. They're back to where they were in December. Booking Travel, also the old price line. We looked at them here at 2000. They flew up to 26. Now they're coming back a bit, but obviously you have to look at where something was on January 1st, basically at the beginning of the year, because we did this thing on the 28th. So when we did it, it was here. Just keep that in mind. So if something is lower, it's a better price. It's where we want it to be. If it's higher, why chase it when there's so many things on sale? Here's BLK. They're down quite a bit, and again, we want to wait and see, and we don't have to catch. We don't have to jump in and say I'm going to call the bottom here, as somebody asked me on Bank of America. You don't call the bottom. Let them show you where the bottom is. Let's start seeing recovery before we jump in and start buying. Let's see them flatten out. Let's see a few of them take off, and then we'll know it's time to get in. BNTX. Oh, where'd I go? Oh, these guys. Oh, they're nice. They're a nice little sporting store, but doesn't not obviously. You don't want to bet on anybody small in this kind of environment. Berkshire's giving a bit of a discount. BXMT. Holy cow! What on earth? Oh, that's the Blackstone mortgages. That's right. They had a lack of faith early on here, and I said at the time, I said it's too cheap, and they make 500 million a year. What's going on? So I'd like to see their earnings report and check, but that's definitely one we want to look at for sure. Here's Boyd. You like them? Citigroup, of course, is back to the lows. Cheesecake Factory pulling back again. Caterpillar pulling way back. I mean, now they're cheaper. They were taking off nicely. Now they're pulling back. But the problem is, there's all these dominoes. So, you know, if Silicon Valley Bank is not a big bank. It's a big bank. It's right on the 250 million is when the Fed starts really, you know, being tighter about the regulations. They were just under that. So they weren't really there yet. So over 250 billion, but like, you know, and then Citibank has a couple of trillion, that kind of stuff. So you got to put it in perspective. But Credit Suisse, $500 billion under management. If Credit Suisse goes, then you got to start worrying about the Japanese banks that are in trouble and the Chinese banks that are all in trouble, all very, very bad situation. But the problem is there's no transparency out there. We don't know what they're doing. We don't know. It's very hard to figure out how much they have in reserves and how much they have on the books and how much is tied up in real estate that they're taking a bath on. It's really hard to tell. Now, if the Chinese banks aren't working or if they collapse, then Caterpillar is going to, you know, Caterpillar can't sell their equipment to people unless they get a bank to finance it. Their stuff is very, very expensive. They're not going to make a lot of sales for cash. So if the banks tighten up and the banks have problems lending, that's going to hurt Caterpillar. But holy crap, I mean, if they come back down in this range, we totally want them. Here's good old Capital One, also taking a dive. Chimera, Eclipse, Comcast coming back down. Everybody's coming down, right? Chevron coming back down. Delta, big dive. I don't, you know, I don't really, you know, how is that really connected to the banks? But of course, you know, lending becomes tight, situations become tight. You could be looking at a recession. So this is kind of a view of recession expectations more than anything else by people. Poor old Disney. Although I got to tell you, Disney, Iger's saying that they're looking to reduce park admissions, because I was saying for a long time that these park admissions have gotten insane. People can't afford to go, and even if you do go, it's miserable. $125 a day for the ticket. So you take your family of 4 people. The ticket is $500 to go in. The hotel is $500 to stay there. It's $1,000. Then you got some food and so on and so forth. So you're paying like at least $1,250 a day to go to Disney. So if you go there for 4 days, it's a $5,000 vacation, and that's if you don't stay at the Star Wars hotel, which is like $5,000 for 2 nights, I think it is. You know, it's great when times are booming and everybody's floating in money, and you can just say, okay, this is for the ultra rich. But you know, when people are cutting back, Disney, see, this is what Disney forgets. They rely on those less affluent repeat visitors, the fanatics who go over and over again and like to take 3 vacations a year at Disney, and that's their lifeblood. And they basically just threw those people under the bus and went after the rich people, and they made a huge mistake. You know, it's like, because once the rich people get bored with something and they move on, and this has happened to whole cities, where rich people have flocked to certain cities and done certain things for a year or two, and then all of a sudden, boom, it's no longer, it's out of favor, and they're begging for people to come. So it happened to Disney too. It was everybody ran over there and did some stuff, and they were raking in cash, and all of a sudden now it's drying up real fast. So it's very hard to go back and try to discount park tickets or do this and that when now they rely on that revenue, and everything else in their company is based on the fact that we get this much park revenue on a daily basis. Now they're not getting it. Is it long-term survivable? Yeah, I guess. Oh, and Disney is Hulu. Disney doesn't have their own streaming network. They got Hulu. CBS has Paramount Plus, and NBC has Peacock, and Disney has Hulu. They don't have their own thing. Oh, I'm sorry, they do. They have the Disney Channel. That's right. Sorry, they have the Disney Channel, but that's not for ABC shows. So they need to do something about that. Dick's Sporting Goods doing really, really well, especially considering what's going on now. Dow Chemicals, always fun to buy when it's cheap. eBay, interesting. I don't know if I want eBay at this point, though. It's a little weird. ERJ, we already took. We like them. ET, I love them for the dividends. Great stock. Here's Expedia, another travel one that's getting killed. FedEx, again, recession fears. Ford, fantastic price down here. I think we just added to it. Future Fuels, another one we love that I've got. FL's holding up so-so. Frontline Tanker, surprisingly, not so bad, but we'd be interested. They do come back. GE has been exploding. Gilead also very strong, so we wouldn't mind them if they come back. GLW, always a good play long term. GNRC is Generac. It's I love these guys for cheap stock. Google having their troubles too. Halliburton has been up and coming down. I wouldn't want to invest in energy right now. Honeywell also had a big up and down ride. IBM, obviously we love IBM. We just bought some more. IEP back to where the lows were, so I kind of like them here. IP, that's interesting. So they're also back to where we liked them, but if they drop back to the bottom, I would certainly like this. ISRG, Intuitive Surgical, very, very good pickup down here. This could actually be very interesting. IVZ, good price. Jack in the Box, not cheaper than where we were looking at them. Jets is the airline industry in general, and also this recession fear is all over. Nordstrom's, not sure I want to jump into Nordstrom. Here's JXN with a big pullback. They went flying higher, and now they massively pulled back. And I'm going to love them again if they come back down in 30. That's phenomenal. KHC, the biotech ETF is just never can get traction. It just does not work out. Levi, they started getting stronger. Now they're back down. Logitech also started getting stronger, coming back down. Lovesac, stronger back down. I mean, these are recession bets at this point. All right, LYB is another specialty chemical company, and they've come back down a lot. So things that got away from you for the watch list, a lot of these are coming back. But again, if everything's going down, don't jump in and buy. We got to wait and see some stability. LVS also needs to come down further. Here's MetLife. I'm loving these life insurance companies. We hadn't gotten into them, but now we're going to, because look at this. We're going from 70 down to 55. That's 20% off. That's just silly. They are not a financial, not the way a bank is. They don't have those kind of problems. Facebook is improving and it's not going down. It's interesting. MGM, Middle B, I like these guys. What are I right there? Newton's law of thermodynamics states even in a recession you need to heat and cook food. That's a good point. Yeah, so yeah, people still need ovens. That's what they make. Moderna, you guys know I love that, so of course I love them down here again. Mittal Steel, also recession fears. Micron, wow, got killed. Netflix was recovering nicely and now it's back to 300. Nikkei, Nike is that's a tricky one. I don't know what I don't have a thought on that. NRG is still pretty cheap. VVNT is getting bought. NLY also cheap. Omni still cheap. OLN is still cheap. PacWest, look at them. Wow. See, now we got to really think about this, and somebody else is too. This is $5. I mean, come on. That's tempting. They're probably one of the most tempting financials. PHM. Oh, that's interesting about the home builders. Homes need to be built. I think we're probably 3 to 5 million homes short in America. We need 3 to 5 million more homes than we have. And we only build 1 million something homes a year. So, and we're not even doing that right now. So if we only build 1 million a year and we're let's say we're 3 million behind, it means we would have to be at double capacity for 3 years to catch up. And that's not possible. But we need to be 50% over capacity for 6 years to catch up. So that means that for the rest of this decade, every home builder should be going full blast. By the way, that goes back to being good for Caterpillar, right? So, so if we have a nice dip and if these things go on a good sale, we really got to think about these home builder stocks because homes need to be built. That's a sector we should really be checking out because we need the homes. It's a fundamental fact that we have to have the homes. So we have to just think about where do we need homes the most and where are they being built and who already has land and so on and so forth. Because again, might be hard for home builders to borrow. That's going to be tricky. Or maybe banks are going to want to lend to home builders because they're the only safe bet in town. Hard to say, right? Here's Petrobras just had an unfavorable court ruling on taxes, and they owe $3 billion to Brazil, but that's from a while ago. They may get taxed again for more recent years, so I wouldn't say that's over. Philip Morris, consumer stuff. Prudential, another insurance company getting beat up. QSR, Restaurant Brands, is another a good stock, but a little tricky if there's going to be a recession. Rail cars, I also like them. We need more rail cars. It's another obvious thing. Restoration Hardware, so the rich person stock. I gotta look at those guys. I think I might want them down here. Transoceans, more oil. Rio Tinto had fabulous run and now crashing back down as if it never happened. SKT's been holding up well. Schlumberger, and again, more oil. I don't know if I trust it. Sony was ridiculously cheap down here. They're still not so bad. Simon Property is a mall operator, and they're having recession fears. SunPower, this is so stupid. That price. STLA is Chrysler. Is it Chrysler? Yeah, Chrysler. Fiat Chrysler. SWK. They can't get any traction. It's kind of hard to say if that's a good bad thing. SYF has fallen back considerably. AT&T is back to a good price. Target still too cheap. THC, hospitals. You don't know what's going to happen with Medicare and Medicaid. That's where they get their money. That's a little tricky right now. All right, TNDM is hanging on. Toyota, again, too cheap. T-Mobile just bought Brian Reynolds' company. So I don't know if they overpaid for it. You got to count how many customers did they pick up for the money. I think this is obviously the market is happy about it today. Trox, Specialty Metals, I love them. TRVG is another travel company. Tesla, of course, was in terrible shape and pumped up, and now they fell back a bit. But I think going forward, they're good down here. TTE, Weakness now, Tupperware, nah, we give up on them. Take two, games I wouldn't touch. UHS, wow. Wow. We were upset that we missed them because they shot up when we were looking at them and they went flying, and now they're back here. So now the question is, do we want it now that it's down here? Visa, again, if there's a recession, what happens? Vail, also getting cheap. VNC, wow, these fall-offs are horrifying. And Walgreens is back to being too cheap. Whirlpool's back to being crazy cheap. That's a little tricky, of course, durable goods during a recession. Walmart, also cheap, but I'd much rather have Target. Williams-Sonoma, again, rich people stocks. I like rich people stocks. WY, that's interesting too. Xerox is interesting. Oh no, I'm sorry, that's US Steel, that's Xerox. US Steel, a little scary. I think I'd rather have Mattel. Yeti, of course, is our trade of the year, and it's holding up today, so let's see what happens. And ZS is still nice and cheap also. Wow. So, I mean, a couple of weeks ago, we were looking at the watch list. We didn't see a single thing we could still buy. Everything was flying higher, and now we've got like fantastic amounts of choices. So plenty of things to consider from the watch list. Naomi says, thoughts on CG, thinking about, all right, well, this is something you should better ask me in chat, because honestly, I'm not going to take too long to go looking over individual stocks. What do we have here? Open another tab, go back to there. Gallery view. You don't know what any financial group is doing right now. So it looks cheap, but you don't know what kind of trouble they're in. And I'm not saying they are in trouble. I'm just saying you don't know. So I certainly wouldn't give you an off-the-cuff answer. It's something I'd have to really look at carefully in chat and figure out, why are they, I mean, everybody's down. But are they down for no reason? Or are they down because they have a lot of exposure that people are worried about? It's you're not going to know for sure. And it's instead of picking stocks now when everything is falling, and again, I think all of this is very premature. It's obviously tempting to jump on every single one of the ones I just looked at. But that's exactly what killed people here. You were 100% too high, or 50%. You were 50% too high. All this bounce area, everything here, 50% too high. I mean, came back here, you're still 50% too high. Could have done way better. Your money dropped 50%. So what are you in a hurry for? Okay, I forget how many, there's a lot of stocks on the watch list. I forget the number, but there's a very large amount of stocks on the watch list. There's obviously stocks all over the place. Carlisle's not one we were focusing on as far as that goes. They might be okay. But the point is that there are so many stocks, and what you do is you wait for them to turn around, not Carlyle Group, but you wait for the financials to stabilize and begin to turn around, and then you look at who's lagging in the group. You say, oh, things seem to be getting better. They passed this, or they passed that, or they promised this, or they promised that, and now things seem to be stabilizing, not just in America, but around the world, because if it's just us, it's not going to help. That's another lesson from 2008. That it doesn't matter it doesn't matter if our Congress passes a stabilization act. If all the banks in Europe are failing, what's the difference? We like to pretend that we can do all this stuff alone, but you can't anymore. That's not how the world works. You know, if banks are failing in Europe, you can't do business in, you know, American companies with American banks can't do business in Europe because there's no counterparties. You're losing your counterparties. How do you do a transaction if you're the only one with credit? Wayne says, would you want to open a new position in SunPower and HBI? I want to open a new position in everything, but I'm waiting. And yes, I'm very concerned about anybody's debt right now. So, you know, HBI, probably not my favorite. Although, you know, it's perfectly normal. They have a normal amount of debt for a retailer. They carry inventory and so on and so forth. But you're in a situation where what if they lose their banking? First of all, any small company at all, unless you know for absolute certainty that they did not have any money in Silicon Valley Bank, you know, you take a company like HBI, okay, it's a $2 billion company, but it's not about how big of a company they are. It's about this. Okay, they for whatever reason they estimate making 344 this year, which would be nice because that would give them a P of like, you know, 5, not 5, but whatever, 4, 10, you know, 6, 7, whatever, 6. I think it's about 6. So that would give them a P of 6. But the question is, they've got 3.4 billion in debt. They have 238 million in cash. Was that cash in Silicon Valley Bank? Do they have access to it? Has it been resolved? Do they have any problems? You know, it's not a lot of money when a $200 billion bank goes bust. You know, and again, everybody's supposed to be getting their money out, but it can cause delays. It can cause you to have problems in this quarter of getting shipments done and moving things forward. You don't have access to credit. You've got to go open up new accounts. And the people of Deluge, Bank of America, just took in $15 billion. Came out of Silicon Valley Bank, went to Bank of America, 15 billion. Why? It's happening everywhere. It just happened to be an article about Bank of America. But yeah, JP Morgan's got $20 billion and Goldman Sachs has 20. Goldman Sachs just bought a whole set of SVB's assets. And they're going to do great. They bought them at a discount. So some people will do well, some people will do poorly. Some companies will do well, some companies will do poorly. You don't know. So that's my answer is I don't know. There's no way we have enough information right now to make that decision. So on any small cap, no, I wouldn't do anything if you can't possibly have enough information to make a decision on small caps. On large caps, yeah. Okay, we will have and again, you got to give them a week to make announcements, but you got to see who makes announcements. There are going to be a lot of companies announcing we have no material impact from this. We have this much impact. You know, you got to watch for that stuff first. Make sure you see a statement and know what's happening. Because, you know, when you have a small company, a relatively small company like this, if they lost $50 million, it's a huge impact on their earnings. Or what if this loan gets called in? What if a portfolio that they got sold to a bank that had a tie to Silicon Valley, and then now the whole portfolio has been bought by Goldman Sachs, and now they're going through it for anybody who might be in breach of covenant, like maybe they're not supposed to have over $3 billion in outstanding debt, but the bank they were in was letting it slide, but because that bank owed some money to because that bank was owed money by Silicon Valley Bank, they had to sell the portfolio to discount, and then Goldman Sachs picks it up, they run it through their computers, and their computers spit out and say, hey, these guys are $600 million over covenant, and now they get a call on their loan, and they have to start raising capital, and $600 million is 30% of their total value. You don't know. And again, this is just with one bank failing. not one bank signature and also, but it's just, this is just a small thing so far. If this spreads, it won't be just maybe your bank people are affected. It'll be how much are they affected. So, you know, when you're looking at this, when you look at this watch list, the ones that are exciting to me is when I see Allstate. You know, like that. I'm like, oh, insurance company, gigantic insurance company, probably not as much risk as people think. Do I want to touch Barclays? No, it's not too exciting to me. BLK, interesting. This might be tempting. Berkshire, of course, obviously, if they're going to get on sale. Citigroup, interesting. Cheesecake Factory, I don't see, you know, again, got to watch what they owe, but I'm kind of interested in that. Caterpillar also going to be very interesting if they keep falling. I want the big ones. I don't want the, even if, you know, I love CIM. I want the big ones. I don't want little ones. Comcast, ooh, Comcast, yeah. Are people going to stop watching TV because there's a recession? Are they going to turn off their cable and cut off their internet? No. But Comcast is also Universal. Disney's crapped out, right? So what about Universal Studios? Are they going to also have a big revenue decline? Is that going to be an issue? Comcast also has a lot of advertising. They're in a lot of ways similar to Disney. So you have to think about that also. Delta Airlines, people still have to go places. People have to fly. Might take a while to come back, might not. So you go. I care about the big cap guys who are probably not going to be affected by this stuff, or even if they are, they'll survive it and come back later. That's what I'm looking at. Not to see what small companies I can throw dice on. UNG is some power down. Are we still okay? I don't know if anything's okay right now. Everything's falling apart. This is not okay. So we'll see. Sophie also, we don't know. We don't know how people are being affected. And certainly don't know anything from a day. Are we okay today? I don't know. Some power. Sophie. Anybody can get caught up in a market pullback. But the question is, are they being pulled back for bad reasons, good reasons, whatever? Okay, that's why we do our portfolio reviews, which I'm starting to do. And we have most of the rest of the portfolios to go. We got to look at all of our companies very carefully, which means it's going to take me much longer, which is going to be a nightmare. Okay, not much voice left, guys, so we're going to not have a lot more time to do this today. All right, so we talked about that. Oh, well, let's go take a look at the portfolio review because we talked about the hedges. Oh, actually, you know what? La-dee-dee. Short term. Now we're not, well, wow, we even lost money today. We're not making progress because we have a lot of short calls in this portfolio, and we'll have to make adjustments. But the adjustments aren't bad because, for example, we have these short 50 calls. Well, we're nowhere near 50, so that's not worth worrying about. We have these DIAs, let's say. So DIA is now, oh, here you go, the April 325s. So now we were even yesterday. We just saw $37,000 today on these short puts. So we have the April 325 puts of DIA. So let's look at that. So la-di-da. Wow. what do we say, the April 325 puts? So the April 325 puts are like 16, let's say $16, right? Because it's still falling. Wow, $5. Jeez. So they're $5. Now, where can we roll them to? Well, if we go out to September, what's $5? The 270s are $5. That's like way, way below. We're at 325, we're at 317 now. The 270s are 40 points lower. So that's another 15% almost that the Dow would have to fall for those to go in the money. So we're not worried about those puts. Even though we're showing a $37,000 loss, we can roll them even to these 270 puts. I think it was $6, right? So let's say the 275 puts. So when you're looking at the portfolio, you also have to consider, like, if this sticks, if we keep going down, what do I do next? Well, I roll to the 270s. If I roll to the 270s even, I can also take steps. What else do we do? All right. So you have to think, if I do that, so I'm saying I look at these and I say, oh, I can easily roll those. I'm not worried about it. But if we keep falling, then I'm worried about these 300 puts as well. And we have the 350 puts. I'm sorry, we have two sets of 300 puts. All right. So the 2024 300 puts, those are at $15. Now, here's the June 2024 300 puts. I'm sorry, puts. So what's at $15? Well, the 290s. That's not much of a roll, is it? So how about the 2025s? $15 is 275. So now I say, okay, so I'm going to roll those to the 275s, but that's not going to make me happy. So what I'm going to have to do is I would probably buy 50 more of these. So we're going to spend $400,000, buy 50 more of those, and then do the roll of these two guys, which will be even. And then we'll have the 400 and the whatever that number, I forgot what the number was, but the 400, 300 spread, let's say there. So we end up with 100 is $1 million. We end up with $1 million spread, but we're going to spend another $400,000. And but then we're out of trouble. Then we're covered and we're out of trouble. So you have to always look at these things and think to yourself, what am I going to do what if I'm wrong and we don't hold this line? What if this is not the end? And of course, we're going to look at our oh, this is not the S&P chart. This is a NASDAQ chart? Yeah. So for the NASDAQ, we're saying, well, hopefully this this is a weekly, the 200 week moving average, 11,725. So hopefully that'll hold. If it doesn't hold, we could easily go back to 11 or even 10,000. It'll be very nasty if this line breaks. We'll certainly go to 11. We may go to 10. Now, if we go to 10, that's down about 15% from here. So again, that's what we'd be looking for, is a 15% correction. That happens to make sense on multiple charts. And I said that anyway. I said on the S&P, 3,600 is what I'm actually targeting for a pullback, and we're still at 38. So that's another whatever it is. It's not even 10% lower. It's not a big deal right now. December 22. Sure, that's got to be the one I'm using. Now, so I'm looking for this pullback here. All right, but that's not very far considering where we are. We're only at 38.62. And notice again, this is the same freaking line that we have been using for a couple of years now, and here we are. See how it comes right to it. We consolidated there at this point when we had the last big sell-off. Well, the last sell-off in December, because we had a bigger sell-off before that. But we had the last sell-off. We held the weak bounce line. That gave us some hope that things were going to get better. We came back to here. But based on earnings at that time, I said, I'm not willing. I don't believe that we're going to go over this line. In fact, we pressed our hedges because I said, I don't think this is sustainable based on the earnings I'm seeing. And here we are down here. But now we have the same crap earnings, the same everything else, nothing, the same war, the same inflation, although inflation is getting a little bit better. The Fed still has to keep raising rates a bit. And we also have an issue where the bank earnings that were reported to us just a few weeks ago turn out to be bullshit. Because now we see from Silicon Valley Bank, we are seeing that they did not disclose the unrealized losses of their treasury bills. That's not good. That's really not good. But I guess insurance companies will be selling off for the same reason, but the insurance companies aren't pressured to redeem their treasuries. They're not going to take a loss. I mean, they kind of take a loss because if you're only getting half a point and interest and inflation is 5%, you're losing 4.5% on your money, right? You're not getting back as much money as you need to maintain it to keep up with inflation. But that's not the business of an insurance company. The business of an insurance company is to pay out their policyholders when the time comes. So as long as they can pay out the policyholders, they're still making money. They might make less money, but they'll still make money. It doesn't matter as long as they can honor their obligation. And that's, by the way, a big flaw in life insurance. You take these policies that pay you $1 million, and 30 years later, $1 million ain't worth crap. That's something people don't realize when they're making all these payments also. But anyhow, so I'm expecting us to fall to here. And we're only here, and we're only bouncing off the bounce line. We should be bouncing off this line. The question is, are we going to bounce weak or strong? So, and we talked about this last week. But if we fell, and that's where these lines are helpful, right? We fell in the short term from 4,000 to 3840. So that's 160 points. That means a bounce is 32 points. So a weak bounce is 3872 is a weak bounce. It's 32 points plus this. 20% of the drop added to this line is your weak bounce. So that's 72, and we're at 62 now. We're not even at a weak bounce line. Above 62 is what? 62 plus 32, 94. So 3894 is a strong bounce. Basically, the 3900 line is a strong bounce. So we went up to the strong bounce, but we went up on no volume. It was bullshit. So we went up to the strong bounce line, but we basically failed there, and now we're coming back, and we're back at the weak. We're back below the weak bounce line. And if we fail the weak bounce line and we start going back down, we're probably consolidating for a move below this line. And then we're going to go all the way down to here before we have the next chance to bounce. So the really significant one, though, is this one, 39.38. That 200-day moving, this is a 200-day moving average at 39.38. You see how the 50-day moving average, though, hit resistance at 4,000, right? So the 50-day is going to get dragged down. How much? I can tell you. It's math. So this is 140 points below there, right? It's a 50-day moving average. So 140 divided by 50 days is 2.8. It's going to be taken down 2.8 points per day if we're at this level. So that means tomorrow it's currently 4,003. Tomorrow it'll be 4,000 if we finish the day here. And what is that going to show, though? Over time, if that keeps happening, it's going to show that we were rejected at 4,000, and the 200-day moving average will start coming down, but this will fall down faster than the 200, and then you'll get what they call the death cross. And when is this death cross going to happen? I can tell you that too. He's going to fall at 3 points per day. He currently needs to fall 60 points to hit the 200-day moving average. But while he's falling, so 60 points is 20 days. But in 20 days, the 200-day moving average will fall 100, half a point. It's only half a point. So in 20 days, this will fall about 10 more points. So it'll take basically a month. So in a month, if we stay below the weak bounce line, then we will then have a death cross in a month. That's how it works. Math. Very simple. It's like the two-train problem, right? To solve. It's like two trains are moving at these speeds, and what's going to happen? See, there's actual relevance to that question. You do have to actually use that in life. And look at the volume. That's also terrible. When you see look at the huge increase in volume on the sell-off. Not good. So anyway, if we fail the weak bounce, and especially if we fall below this line, then that's going to accelerate the decline of the 50-day moving average substantially. And it's always going to accelerate 4 times more than the 200-day moving average. And so once we're below this line, we're basically sealing in our doom. And what happens on April 15th? The next earnings cycle starts. And the next earnings cycle starts with banks. So do you see the setup for a complete catastrophe? So we got that to look forward to. Now, hopefully, and honestly, I don't believe this anyway. Hopefully, the government realizes this, the Fed realizes this, and they're going to do something now to fix it. But there are really no people who do this. I mean, honestly, it's not an ego thing. I mean, I've been doing this for 30 years. It's so weird. No matter how much I talk about this, and no matter how much I explain to people what the 5% rule is, and how you can see what's going to happen on a chart in advance if you just do the math, who else does it? This is the most obvious thing in the world. It's like this, and then everyone's gonna be surprised. It's like, oh my God, look at this, it's in the death cross. All of a sudden there's a death cross and the banks report bad earnings because they will have to start marking their things to market, and everything is a disappointment and blah, 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 and everything collapses. And everybody's like, who could have seen this coming? It's like, yeah, this is what you call seeing it coming. I'm telling you what's gonna happen in 30 days. All right, well, we'll deal with that when we have to, but right now we're okay, and right now I'm hoping that somebody besides me sees this and is going to do something about it policy-wise. The Fed's got to do something now. They can't wait, because if you wait until you have the bad news and you have the technical death cross and everything is lined up against you, it makes it 10 times harder. Then the momentum's against you, right? Now you could kind of put the baby, the genie back in the bottle, or whatever you call it, because it's not a genie. There's no wishes being granted. But now you could do something. I'm not sure what though, because the problem is that you're going to only panic people by doing some kind of massive bank bailout or setting up an emergency facility. You could actually cause the panic you're hoping to prevent. So it's tricky. I don't have all the answers. I just have most of them. So Bernie says, Bernie's saying, what do you think the Fed should do on hikes? I would, well, Powell said he's going to be data dependent. I would say we are being data dependent. The inflation number has softened. The economy is slowing down a bit. And in light of the recent issues with the banks, we do not want to put adverse pressure on them, so we are only going to hike 0.25%, and we will continue to be data dependent going forward. That's exactly what I would do. I would not do zero, because you could panic people by doing zero. I certainly wouldn't do a cut. That would immediately panic people. I would go with a 1/4 point increase because it really, in the grand scheme of things, is meaningless. And I would say that we are totally data dependent, but we think this is appropriate at this time, and we'll measure it until the next meeting, which is only a month later anyway. And the next meeting, you could say, okay, we're doing 0 because things are weaker than we thought of earnings or whatever. So there's your answer. That's what I would do. That's what I would do if I were in charge of the Fed. But I'm not. They never give me the job. Pass me over every time. Oh my God. Could you imagine I had to sit there at those frickin' meetings? Oh, wow. I would shoot myself. I would just blow my brains out all over the table. So it's a good thing I'm not in charge. What else? You're talking about portfolios, right? Portfolios, yes. So we added this FAS spread, and we paid for this spread. So the June 21 30, we're at 25 now. So it's not going to take very much. We're at 264 today. So 2 more days like this, and we're in the money. It is a 9 times 100, so it's a $90,000 spread. We paid for it. The spread itself was $20,000. Remember, $90,000 spread. Spread itself was $20,000, and we sold these 2 puts, which is the whole $20,000 basically. We sold those 2 puts against it. So it's effectively free. Now, are we worried about being assigned here? Well, Goldman's at 300 and would have to go to 200, and JP Morgan's at 127 would have to go to 100. So he loses 25%. He'd have to lose 33% before it's a problem for us. And even if it is a problem for us, I still wouldn't mind owning them at those prices. We have a ton of cash on the sidelines, not a worry. Yeah, somebody was freaking out yesterday in chat about like, oh, it went down. What do we do? I'm like, you don't do anything. We bought it for a hedge. It's supposed to lose money if the market does well, but you better goddamn well have enough longs that are going to make money to make up for it. So the easiest thing to do is to make some fixes to the DI. I'm not doing any of this, so I don't see right now. We don't see the need. We don't know until we really fail that 3840 line. But if we fail that, then we're not going to wait too long before we make adjustments. SQQ's fine. We could always roll the 90s higher, but 90 is so high. We're only at 38, so 90 is very, very unlikely to get hit. This went a bit negative. I'm certainly not even worried enough yet to buy back the 50 calls, and it's only at 150 out of 800 uncovered, so I'm not worried about that. And TZA, again, also, we have the short 70 calls and we have the short 50 calls, but how much are the 50 calls, the 70 calls? The 70 calls are, oh, they're the wrong year, sorry, silly me. Okay, so the 70 calls is 6, it doesn't matter. We could always roll the 50s up to, okay, so the 50s, let's look at that, 2025 50s, TZA. So the 2025 50s are, well, they're 13 bucks, let's say. The 70s are 9.25, let's call them 10 bucks. Okay, so I'm saying, so the 50s were what? 13. So these are 13 and these are 10. So that means for $3, we can roll, where to go? We can roll these 50s up to the 70s. So for $3, we can buy $20 more upside. That's how you adjust the spread when you're having a crisis, right? Because the premium of the higher short calls expands faster than the premium of lower short calls. So we take advantage of that by doing that roll. We roll the 50s to the 70s. And again, I don't even think that's going to be reachable. So it's kind of hard to worry about, but it would make the portfolio less ugly because we would have so much headroom. Then we would have 20, 50, then we'd have 8, is it 800,000? let's see. It's net, oh no, the spread would be then 20 to 70. The whole spread would be 20 to 70. So we'd have $50 times 4, 2 million. So it'd be a $2 million spread. And it would cost us $3 per long. So it would cost us $90,000 to expand the spread by $600,000. Totally worth it. So that's how you make use of your sideline cash. Okay, you take advantage. Always, how do I take advantage of the current situation? What's the current situation? The VIX is very high and TZA is rising rapidly, right? You have to think first about what's going to benefit. How is it going to work? So TZA is rising rapidly. It was 27 like a week ago. Now it's 35. So TZA is rising rapidly. 50 is still way off there, not that likely. And we topped out last crisis, we topped out at 40, 47. So 50 is a long way to go. But let's say we need to make an adjustment. Well, that's my adjustment. Then I'm going to spend $3 to roll the 50s, the short 50s to the short 70s. That's going to give me $20 times 300 is $600,000 more breathing room. And more insurance going down. Now, that insurance only pays off, though, between 50, which is 50% more on TCA, which would be a 15, 16% further down in the Russell. So it starts at 16% drop, and it terminates at 70, which would be 100%. So it terminates at a 33% drop. So the extra insurance I'm buying is only valid from 16% to 33%. So if I don't think the Russell is going to fall 16%, what the frick am I doing? Doesn't make any sense, right? Why push the short calls? And don't forget, this is only half of my short calls anyway. Why push the short calls if I don't think the Russell is going to fall more than 16%? That goes back to the chart. So now we look at the chart. Oh, you know what? I don't think you can look at a Russell chart. Let's see. No, there's a whole thing about the Russell. It's weird. Russell. Oh, what's that? Okay. Well, what the frick? Russell started like doing something about the way that they make sure services pay them a lot of money for like any kind of information, and so nobody uses them. I guess the ETF. All right, we'll go by IWM because that's going to have enough volume to make it lookable. So the question is well, percentage-wise, the Russell on a percentage basis hasn't been more than 20% higher than it is now since early 2022. It has certainly never been 50% higher as 220. So it's 50% higher at the peak. And that's where our additional insurance would only kick in here. It has to basically be 100% higher at 300 for us to get to 70 on TZA. It's just simply not likely. In every crisis we've seen of the Russell, including 2020, we have not been up at 300 on IWM. I hope that's not, we're not comparing apples to apples, but you get the idea. So this is how you got to look at it and say, well, what's realistic? And it's not, and again, it's not because of the chart either. It's because of you're talking about the Russell coming down to a PE below 20, which is highly unlikely. Now, when the Russell was high. Oh, I'm sorry. We're talking about the lows. I'm looking at the highs. This is because the other one was inversed. So I'm sorry, we'd be looking at the lows, but you get it's the same point. So this would have to drop 50%, and that's just simply not going to happen. 50% would be 80, would be like way down here, same problem. So I'm sorry, because this is a positive and the other one's a negative. Now I lost my train of thought. Realizing one thing made me unrealize everything else. That's because it's the opposite point that I'm making. Oh, valuations and such, yeah. So it's about, and we don't do the valuation model on the Russell because there's no dominant stocks on the Russell, but for the NASDAQ and the S&P, we run the valuation models and we know exactly how far they're going to fall because there's a certain point at which it becomes unrealistically low. And the same for the Russell. When the Russell was, that's what I was going to say. When the Russell was up here in the fall or in the summer, I said this, and even here, I said this is 35. This was 35 times earnings when the Russell was up here, and I said that's not sustainable. Yeah, were we even higher than that before? We were, but this was idiotic. But that was because of stimulus. Without stimulus, how the hell can you possibly sustain 35 times earnings? There was no possible way. That's why we were short. It's just not possible to be higher than 35 times earnings for the index. It just made no sense as an investment, especially when for risk-free, you could get 3%, because that's what it is. When you're paying 35 times earnings, that's 3%. You're basically getting a 3% rate of return. But it's a risky 3% rate of return. When you get a risk-free 3% rate of return in the bank, why on earth would you put your money in the Russell? It makes no sense. And lo and behold, money started coming out of these indexes and going into nice, safe bank returns. But now the bank returns might not be as safe as you thought because the banks aren't stable. What a mess. Ooh, the markets are flying up, Robin says. Nope, there's no reason. There was no reason yesterday. Somebody is manipulating and jumping in and trying to make things look better. There's no reason to it, but this is the same bullshit we had yesterday. See a sudden spike yesterday, and now we're having a sudden spike today. See there, you can see the spike forming over there. There's no reason for this. It's just a sudden surge. And there's something called, they call it the plunge protection team, where the Fed and the banks get together and they will boost the markets. They'll suddenly start buying equities and putting bids in to jack up the prices, and hopefully they can cause a rally. That's what they want to do. But again, this is why we don't do anything right now. This is why we just watch and see what happens. Because I don't want to spend money on more short positions. I don't want to spend money on long positions. I want to see how things shake out over the next week or two. If something breaks down, fine. But so far, we haven't broken below the lines we expected to hold. 38.40 is still holding up. We just looked at that. 38.40 is still holding. If that's still holding, we're still in this zone. Just because we dip to the bottom of the zone doesn't mean it's going to break. We're still very firmly in this zone for the last several months. And is this enough to break us below that zone? So far, there hasn't been the kind of contagion that would demonstrate that. But you never know what's going to happen tomorrow. You don't know what's going to happen with Credit Suisse. You don't know if there's other banks that are going to suddenly do this. But at the moment, not enough bad news to break 38.40. That's great. And on the NASDAQ, same thing. We haven't broken below the 200-week moving average. And if we haven't broken below that, we're still in a generally decent position. This is we're getting to this little squeeze area here. Eventually the 50 is going to cross the 200, but it's going to take a while. It'll take a couple of months, but there's going to be a point at which these two things squeeze, and either we go above and we don't get a death cross, or we squeeze below and we absolutely are going to get a death cross, and then that's again bad sign. But until we either get one or don't, Don't know what we're doing. Best thing to do is sit and watch and wait and see what happens. And that's why, yesterday we did not pull the trigger on any really, I going through the portfolios, I didn't see anything I particularly wanted to jump on because there's too much uncertainty. But on the other hand, I didn't see any reason to dump out of things because there's too much uncertainty and they were damn good positions. I'm not going to dump really good positions for no reason, especially when we have plenty of hedges. So we'll see. That's all. I'm sorry. There's no easy answers now, except for just keep paying attention, and we'll see what gets affected and what doesn't. We'll see how fast things do turn around. But that's what the watch list is for. It's such an easy reference to be able to go by because it updates constantly, and all you have to do is refresh it, and you see exactly where we are at the moment. And then we'll see who's holding up and who's not holding up. And when everybody starts going up, and you see a couple of guys who are still lagging, you say, oh, there's my boy. And obviously you want to see why they haven't gone up, but you see a couple that are lagging behind that haven't gone anywhere yet, and you say, oh, look, Delta's still low. Broadcom is, well, not Broadcom, but here's Apollo, Allstate. Yeah, Allstate's a good one, right? So if the other financials take off and Allstate's still down here, and you look it up and you look at what they said recently, and you don't see any red flags, you say, hey, I get to buy Allstate for 30% lower than it was when we picked it for the watch list. That's good. I wanted to see a pullback in Allstate. I wanted to buy it. That's why I was on the watch list. I got a 30% pullback. This is when you do want to buy it. I mean, frankly, I almost feel like it's all, again, if we really are clearing up, if we make it through this week and we're above our bounce line, don't forget, we got to be above that week bounce line, but if we're above the week bounce line, get through this week, and there's no more like looming catastrophes that we know of, we're going to have to strongly consider like selling some puts on Allstate and maybe a couple of other guys to pick a position. But again, let's go through we're going to do our portfolio reviews first. We're going to see what things, well, we see how much money we have to buy things with. Because our first obligation is to improve positions we do have and to make sure that we're in a position to win on the stocks that we have. Because if we owned Allstate, we'd be damn well rolling down our calls. That's different. That's an automatic thing. Because like, let's say we bought Allstate here, and let's say we bought the 130-150 spread, right? Okay, let's just, for example. So ALM. So Allstate was at 140. So let's say we sold the 140 puts, and let's say we sold them for 20, and now they're 30. And we took the 120, what did I say, 120, 150, right? Let's say we took the 120, 150 spread. Okay, so that's 2024. Oh, that's why we don't own Allstate. Look, they only go out to 2024. So the 120s are now 857. Let me get rid of that. So the 120s are now 857. The 100s, what? The 100, that's because nobody's bought them in a while. The 100s are now like 18. So it's $10 more for the 100s. The 110s are, let's say, 1050. Is that right? No, that can't be right. Sorry, these. So these are like 13. So these are 13, the 110s. The 120s are 850. So how much more is 13 than 850? It's 450. That's a good roll right there. So I don't need to know that we're at a bottom to pay $4.50 to improve my position by $10. Because why? Because let's say it was worse. If it was worse, it would be like these rolls are cheaper, right? So if it was worse, it would be like rolling the 130s to the 120s, and the 130s are, let's say, $5, and the 120s are $8.50. So it's only $3.50 to roll from the 130s to the 120s. You understand? So the further below the money you are, the cheaper the roll is going to be. So we can roll now for $4.50, but if it got if it got significantly worse, we could roll for 350. But I'm not going to not roll just because I might save $1. I'm perfectly happy buying $10 of position for 450. And if it could have been 350, then oh well, I didn't make it. But that's the point. So in other words, I look at my rolls first. My first obligation is to look at all my positions, say, should I roll this? And if I feel that my target is now unrealistic, and don't forget, we're at 109 now. So if I was in the 120s and we're at 109, I'd be like, oh, you know what? I would really feel more comfortable if I was at the 110s. Also, being at the 110s where I'm at the money means I feel more confident selling short-term calls if that situation comes up. So I'm spending $450, but I'm keeping myself in a position where I can sell some short calls, like, for example, the June 130s, which are $1.25, or let's say even the 125s, which are $2. Well, I mean, that's actually quite far out of the money because we're only at 109. So let's say I sold those. So I would have no problem selling these for $2. Now, what did I do? I rolled down my long calls. That put me in a position to recover half of the money by selling some short-term calls. Totally worth it. Because I'll sell another set, right? This is only a 93-day sale. So I can make 2 more sales like that. I can actually recoup all the money I'm spending on the roll by selling short calls, because my short calls put me significantly in the money compared to the short-term calls I might sell. See how that all works? So I'm not scared of making that roll, and I don't have any reason not to make that roll, because I'm going to stick with Allstate. I want to be in the money, and putting it in the money can generate income for me. So that checks all my boxes. So if I had that position and it dropped that much, I would then roll my calls lower, sell some short-term calls to pay for part of it, and then I'm in good shape, and I have a much wider spread going forward. So that's our first obligation, looking at the positions we have. Can we or should we improve them given where we are now, or are they still in the money and fine and we don't need to spend money on it? I don't want to spend money if I don't have to. But I do have to if I'm now out of the money on my Allstate position, and I don't see that they're going to bounce all the way back and take the 150s like I thought they would originally. So every position, everything I'm telling you, that's just a tiny part of the research I do on every single position before I start doing these reviews. So it's like freaking hours and hours and hours that I put into these things. But all that is taken into consideration, just so you know, and we decide. And then I end up saying, like, on track. After all that, I write 2 words. But when we decide to make a move, that's why, because I'm taking these factors into account, deciding that our money is better used for this or that than to leave it on the sidelines. But then after we're done with our adjustments, then we look and say, well, how much cash do we have available in our portfolio, and what kind of positions do we need to help diversify it better? And then we decide which off the watch list we want to pick to add to the portfolio. Which, what would be a nice thing? I don't have any insurance plays. I don't have too many financials. I don't have any biotech. Whatever it is, we start looking for things that fit the criteria that will diversify us and add another great bargain into the portfolio. So those are the steps of the process that we use in order to start adjusting and building our portfolios when we have a crisis. But we're early in the crisis, and we're certainly not looking to deploy a lot of cash until we are sure that we're going to come back. And that's what we're waiting to see, is will this stuff stick? In fact, yesterday, it was right yesterday, because yesterday was in the afternoon, and I'm sorry, we finished yesterday strong, right? I remember this was happening at 11, and I was like, this is bullshit. That's what I said yesterday at 11. I was like, this is bullshit, but whatever. Then we came back down. Then I felt calm. Then I was like, okay, that makes sense. This makes a lot more sense to me. Then we went flying up into the close, which I said was bullshit. And then, but we held it all night. And then all of a sudden this morning, back down again because of Credit Suisse. You know, but, and again, this is bullshit. There's no way you can be this confident based on what's been said so far and done so far. We are not fixed enough for you to get all confident like that again. But what is happening, and now we're back to technicals, what is happening though is clearly we bounced off the 200-day moving average, the 200-week moving average. It's a very strong technical support line. And that's why we're bouncing back up again. But the question is, 1270, will we crack? Oh, well, that is cracking 1270. All right, so yeah, we're over 1270, so we're actually in not bad shape. Has this not been updated? It says 12229. Yeah, so we're over the 12070, the 12070 line. That's the key. So if we're over this blue line, the 200-week moving average, that means we're pulling it up. We're not going to have a death cross. Things are going to have a chance to recover, and we should be okay. The S&P, as I said, we've got to clear this bounce line. We really got to clear this red line. Once we're over the red line, same thing. You're averting the death cross. You need to do that. You need to get this blue line over that resistance. Then we can start making some progress up. But is there any particular reason we should be as good as we've been for the last month? Based on the new information we have? No, not really. So that means to me, it's kind of hard to get over this 4,000 line until we have some clarity on the banking situation. All right, well, I said I wasn't going to talk that long, and I ended up talking long anyway. All right, guys. So that's that for now, and back to portfolio reviews and so on and so forth. And I'll see you guys. Oh, might not do one next week. Wait. No, next week, yes. The week after, no. Yeah, okay. A week after, 2 weeks from now is my birthday, so I'm not sure I want to do a webinar on my birthday. We'll see, but I kind of think I'm not going to be in the mood. I'll talk to you guys later. Have a great week.